This lesson is called The Account in Accounting. At the end of this lesson, you should be able to define the 5 types of accounts accountants use, give examples of each type of account, and then explain the matching rule for revenues and expenses, and analyze basic revenues and basic expenses under the matching rule. So what is an account? An account is a collection of information about similar events that we call transactions. We group all transactions of cash into an account so that we know how much we have increased cash and how much we have decreased cash at the end of a period. We do this for every similar kind of account. If we have payroll expense, if we have sales revenue, if we have inventory, there are decreases and increases in every account. The account balance is the ending answer to the question, the balance equals the beginning amount plus increases to the account minus decreases to the account during the period. So what are accounts used for? Well, the balance in each account is the amount that goes into the standard formats of financial statements. Every statement contains a specific list of accounts, which is something we've been working on during class time. In the financial statements, certain balances are required to be disclosed separately, like cash, and other things can be combined together, like you might see the title administrative expenses and not really know exactly what the sub amounts of that total balance are. But that's acceptable. The consistency concept addresses whether a company uses the same rules over a period of time. This idea recognizes that companies do have choices among methods when they do a transaction, but almost all the time, once you start using a certain accounting method, you have to stick with that method so that when you look at financial statements for a company over a period of time, changes for that one company are not simply due to the company adopting different methods. We've been working on the 5 types of accounts in class. To remind you again, the 5 types of accounts are assets, liabilities, equity, revenues, and expenses. There are some other types of accounts. For example, there's something called a contra asset. We'll get into those later in the course. We're not quite ready for those yet. So at this point, the other thing you need to know besides these 5 types of accounts is that every single account can only be one type. That doesn't mean it can only appear in one financial statement, though. Think about cash. Cash appears on the statement of cash flows and it appears on the balance sheet. Retained earnings appears on the statement of retained earnings and it appears on the balance sheet. But the type of account cash is always stays as an asset. The group of accounting rules that are followed in the United States are called Generally Accepted Accounting Principles. We say GAAP. This is the broad set of rules that cover everything a company does that relates to accounting. The term generally accepted means the methods are accepted by the financial statement regulators and accountants alike. U.S. companies follow U.S. GAAP, but every country has its own version. Some countries' GAAP accounting rules are very similar to the United States, and some are extremely different. You follow the rules according to what the requirements are in the country where your company is located. Under GAAP in the U.S., old accounting rules stay in place forever unless a new rule is issued. In some countries, GAAP is driven by laws and not by accounting rules. In those countries, GAAP changes much more often. So what do we need to know about assets beyond what we already probably know, which is that these are things a company owns? Well, the more specific accounting definition is assets are things the company owns that help the company earn revenue. They're things that have value into the future. Some kinds of assets are expected to last for many years. For example, an art dealer might own a sales and storage space on a main street of a town. Some assets last for a shorter time. For example, the art dealer has the asset called inventory, which is art they're going to resell at their store. The thing all assets have in common is that they have future value. They're not completely used up at the end of the current period. Assets always appear on the balance sheet. All right, then let's talk about the liability. Liabilities are amounts the organization owes to others. Debts it owes might be for rent or to employees, might be to the bank for loans. It could be for almost any cost that the company has incurred that it hasn't paid for yet. Some liabilities are paid off each month. For example, employees are paid each month. Other liabilities are paid off over a very long period of time. For example, an art dealer might have a loan that they use to buy and renovate a storage space. That kind of loan, called a mortgage loan, shows up on the balance sheet under mortgages payable. Liabilities appear on the balance sheet. Equity accounts come from two sources. Equity has either been earned because the company made profits, or it's been contributed because investors have bought stock and given the company money. In a publicly held company, the equity accounts you'll commonly see are common stock, which is the contributed part of the equity, and retained earnings, which is the earned part of the equity. Equity appears on the balance sheet. Revenue accounts track the amount of money a company earns by conducting its main business. Selling products, providing services, or doing both things are the common sources of revenue. Selling products is selling tangible things. An art dealer sells art, paintings, and sculptures. Providing services might be, for a construction company, revenue from doing construction work like building a house. An art dealer might also provide services if they restore paintings or clean frames or do things like that. There's a huge variety of ways to earn revenue. Music performers earn revenue by selling t-shirts and by performing at concerts and by recording music and by writing songs they sell to others. Most organizations earn revenue in more than one way. Revenues appear on the income statement. Expenses are costs the organization incurs in order to be able to earn revenue. There's always some sort of link between an expense and a revenue for a company. Here are some examples. The art dealer has to buy cleaning services for its store. People to come in and shine the floors and vacuum and wash the windows. That's an expense for the art dealer so that the store looks nice and people will be attracted to the art store and come in and buy some art products. The musician has a backup band that plays during concerts. The cost for these other performers is an expense that's connected to the revenue the musician is earning from providing the concert. A hairdresser has to pay for hair products used on customers. Those shampoos and so forth that they use when you have your hair done are an expense to the hairdresser that's linked to the hairdresser's revenue from cutting your hair. Expenses appear on the income statement. This concludes this lesson.